Welcome to the Deep Dive. We're your shortcut to getting up to speed. Today, we are diving into probably the biggest economic question on everyone's mind right now. Is the Fed really gearing up for an interest rate cut in September? We've looked at the market analysis, Chair Powell's latest comments, the really nuanced stuff, and of course, the hard economic data. Our goal here is simple. Quickly unpack all these signals, the numbers, the shifts, so you understand why the market is suddenly so convinced about a September move. It's quite the shift. Okay, let's unpack this. Maybe start with the market. That reaction was pretty dramatic. Yeah, eye-opening is a good word. That probability number from the CME Fed Watch tool, the one tracking expectations, it surged. Went from around the mid-70% chance of a cut right up to nearly 90%. And it happened almost immediately after Powell spoke at Jackson Hole. Like, boom.
What's fascinating here is just how direct that link was. Powell speaks, market reacts instantly. And his language, well, everyone heard it as dovish. That Fed speak for signaling lower rates might be coming. He explicitly said downside risks to employment are rising. That's a big deal for the Fed. And he also played down the inflation impact from tariffs, suggesting it'd be relatively short-lived.
Right. Those specific phrases seem to really land.
They did. It signaled a clear leaning, you could say.
And that leaning, well, it throws that core Fed challenge into sharp relief, doesn't it? Their dual mandate.
Oh, absolutely. It's the constant balancing act. Maximum employment versus price stability. Keep jobs plentiful, keep inflation low. And right now, those two goals are really pulling in opposite directions. You've got a cooling labor market screaming for a rate cut, but inflation's still kind of sticking around, suggesting maybe they shouldn't cut. Powell's comments, though, they strongly suggest, at least for the near term, they're prioritizing the job side, protecting employment.
Okay, so if employment is the focus right now, what specific numbers are they pointing to? What are they watching?
Well, the big one recently was the July jobs report. It definitely showed a slowdown, only 73,000 jobs added.
73,000. That's way below expectations, wasn't it?
Way below. And maybe more importantly, they revised May and June down by a combined 258,000 jobs.
Wow. That's a huge revision.
It is. It changes the picture quite a bit. And the unemployment rate ticked up slightly to 4.2%. Powell actually highlighted that headline rate, 4.2%, noting how changes in who's looking for work are affecting it. It's not just the job creation number they watch.
Okay, so the jobs market is clearly, losing steam. That seems pretty clear. But what about the other side of that mandate? Inflation. What's the story there?
Right, inflation, it's a more mixed bag, honestly. Headline CPI, the main number, stayed put at 2.7%, still quite a bit above the Fed's 2% target. But the one the Fed watches more closely, core CPI that strips out food and energy, it actually went up to 3.1%.
Okay, so underlying inflation isn't exactly fading away then.
No, not fading quickly. And then there's the producer price index, the PPI. It measures costs for businesses. It saw its biggest monthly jump since March 2022, rose 0.9% in July, and a lot of that was linked to those tariffs Powell mentioned.
So costs are going up for businesses, which could mean higher prices for us down the line.
Potentially, yeah. That's the risk. But it seems the Fed is betting, or perhaps hoping, that the tariff impact is more of a temporary blip, not a sign of, persistent underlying inflation.
Okay. So what does this all mean? Let's try and pull these threads together. We have cooling labor market, Powell sounding more dovish, inflation that's sticky but maybe has some transitory elements. Where does that leave us for September?
Well, putting it all together, the case for a September rate cut looks very strong. Very strong indeed. You have the clear slowdown in jobs, combined with the Fed signaling they see the recent inflation pressures, especially from tariffs, as likely temporary. It points towards them acting to support the labor market. It's not 100% lock, and nothing ever is with the Fed, but
the evidence is stacking up.
Exactly. The evidence strongly suggests they're preparing to ease policy. They seem willing to accept a bit more inflation risk to keep the jobs market from weakening further.
So the key takeaway from our deep dive today seems pretty clear. The market's sentiment, Powell's own words, the jobs data, even the Fed's interpretation of inflation, it's all pointing quite strong towards a rate cut next month to support employment.
This raises an important question, though, something for you, the listener, to think about. How long can the Fed keep prioritizing one side of its mandate, the job side, if inflation doesn't cooperate and start coming down more convincingly? What happens then?
That is the crucial question for the months ahead. Thanks for joining us on this deep dive into the Fed's likely next move. As always, keep digging and stay informed.